Mercedes-Benz just dropped a bombshell, and the entire car market is still trying to process what just happened. This wasn't a small announcement, a quiet press release, or a minor update hidden in fine print. This was a strategic move so aggressive, so unexpected that competitors, dealers, and even longtime Mercedes loyalists are scrambling for answers. When a brand built on luxury, exclusivity, and premium pricing suddenly changes direction, the shockwaves travel fast. And right now, those shockwaves are ripping through the global auto industry. For decades, Mercedes-Benz stood as a symbol of high margins, elite engineering, and a carefully protected premium image. But now, the company has signaled that it's willing to rewrite its own rulebook. Insiders are calling it a survival move disguised as innovation. Rising interest rates, slowing EV demand, and an oversaturated luxury market have forced Mercedes to make decisions that would have been unthinkable just a few years ago. This isn't about chasing trends anymore. This is about defending market share in an industry that's turning hostile by the month. The most shocking part is how directly Mercedes is going after price sensitivity. The brand that once dismissed affordability as someone else's problem is now openly acknowledging that consumers are tapped out. Incentives are getting deeper, trims are being restructured, and pricing strategies are shifting in ways that immediately undercut rivals like BMW, Audi, and even Tesla. Dealers are being pushed to move inventory faster, and that pressure is already showing up on lots across major markets. But this bombshell isn't just about prices, it's about positioning. Mercedes is quietly reshaping its lineup to focus on what actually sells, not what looks good in glossy ads. Several underperforming models are being sidelined, while high-volume segments are getting unexpected upgrades and aggressive financing support. This sends a clear message to the rest of the industry. Emotional branding alone no longer works in a market driven by monthly payments and resale value. Electric vehicles play a huge role in this shock announcement as well. Mercedes invested billions betting that luxury buyers would lead the EV revolution. That bet hasn't paid off the way executives expected. Inventory is stacking up, depreciation is hitting hard, and consumer hesitation is growing louder. Now Mercedes is pivoting, slowing EV expansion in certain segments while reinforcing hybrid and combustion models that still generate reliable demand. This reversal is sending a chilling signal to automakers who went all in on electric without a backup plan. Dealers are caught in the middle of this sudden shift. Many invested heavily in EV infrastructure and premium showrooms, only to be told that volume and speed now matter more than exclusivity. The pressure to discount is real, and it's changing how Mercedes vehicles are perceived on the street. Once people see consistent price drops, the psychological barrier around luxury begins to crack, and that's a dangerous but calculated risk Mercedes is clearly willing to take. What makes this move truly shocking is the timing. The broader auto market is already fragile. Consumers are delaying purchases, lenders are tightening approvals, and used car values are sliding. By making such a bold move now, Mercedes isn't just reacting, it's forcing everyone else to react. Competitors can't ignore this without losing buyers, and matching these strategies could destroy their margins even faster. Behind closed doors, analysts are calling this a reset moment for the entire luxury segment. If Mercedes can normalize lower prices and higher volume without collapsing its brand, the definition of luxury may change forever. That's why this announcement matters far beyond Mercedes itself. It challenges the idea that premium brands can stay insulated from economic reality, and as this strategy begins to unfold, the real consequences are only just starting to surface. Because the next phase of this decision is where the pressure intensifies, the risks multiply, and the industry starts to reveal who was prepared for this shift and who was never ready at all. The ripple effects are already becoming impossible to ignore. Within days of the announcement, rival automakers began quietly adjusting their own incentives, not publicly admitting it, but clearly responding to the new pressure Mercedes just introduced. When the benchmark luxury brand moves first, everyone else is forced to follow or risk watching showroom traffic evaporate. This is no longer a theoretical shift, it's happening in real time, and the numbers are starting to tell the story. BMW dealers are reporting increased pushback from customers who now walk in armed with Mercedes price comparisons. Audi is struggling to justify its premium trims as buyers question what they're really paying extra for. Even Tesla, which once operated in its own pricing universe, is feeling the squeeze as luxury buyers suddenly have more options with familiar badges and aggressive deals. Mercedes didn't just change its own trajectory, it destabilized the competitive balance across the entire market. The internal strain at Mercedes is growing as well. Engineers, marketers, and dealers are being pulled in different directions as the brand tries to balance heritage with urgency. Luxury is supposed to feel timeless, but this moment feels rushed, reactive, and intensely pressured by financial reality. That tension is now embedded in every decision the company makes, from feature packaging to production volumes. What's especially telling is how Mercedes is communicating now. The language has shifted from aspiration to justification. Instead of selling dreams, they're selling value, efficiency, and smart luxury. That phrase alone signals a philosophical pivot, one that acknowledges the buyer has changed. Today's customer is less impressed by badges and more concerned about payments, depreciation, and long-term cost of ownership. This shift also exposes a deeper problem facing the entire industry: overproduction. For years, automakers assumed demand would keep rising. Mercedes, like others, ramped up capacity, expanded model lines, and priced for optimism. Now reality has caught up. Inventory sitting too long becomes toxic, and the only cure is movement, even if that means sacrificing margin and prestige in the short term. The used car market is another pressure point that cannot be ignored. As new Mercedes prices soften, resale values are feeling the impact. Lease residuals are under strain, which creates a feedback loop that makes future pricing even harder to sustain. This is a dangerous cycle, but one Mercedes seems willing to enter to avoid a far worse outcome: complete stagnation. And while consumers may celebrate better deals today, the long-term consequences remain uncertain. If luxury brands race to the bottom, product differentiation weakens, innovation slows, and the entire premium segment risks losing its identity. Mercedes is betting that it can thread this needle, that it can move metal without erasing what the three-pointed star represents. What comes next is the most critical phase of all, because once buyers recalibrate their expectations, there's no easy way to reverse course, and the next decisions Mercedes makes will determine whether this bombshell becomes a masterstroke or the beginning of a far deeper reckoning that the industry is not yet prepared to confront. The real test now lies in how far Mercedes is willing to push this strategy before the cracks become impossible to hide. Early data suggests that showroom traffic is increasing, but higher footfall doesn't automatically translate into healthy profitability. Moving vehicles at thinner margins creates short-term relief while quietly building long-term risk, and that tension is now hanging over every executive decision inside the company. Suppliers are starting to feel the pressure as well. When a manufacturer tightens costs, it rarely absorbs the impact alone. Component makers, logistics partners, and even software providers are being asked to cut pricing or renegotiate contracts. This kind of squeeze can ripple backward through the supply chain, weakening the very ecosystem that supports premium manufacturing standards Mercedes is known for. There's also a growing concern around brand dilution. Once a luxury brand becomes widely accessible through discounts and incentives, perception changes fast. Customers who paid full price just months ago feel burned, while future buyers begin to expect deals as the norm. Mercedes is walking a narrow path where every additional incentive risks training the market to wait rather than buy. International markets are adding another layer of complexity. What works in North America doesn't always translate to Europe, China, or emerging economies. In China especially, luxury demand has softened dramatically, and local competitors are far more aggressive on pricing and technology. Mercedes is now fighting on multiple fronts, forced to adapt its bombshell strategy region by region without losing coherence as a global brand. Technology investments further complicate the picture. Mercedes has poured enormous capital into software platforms, digital dashboards, and autonomous features that have yet to deliver clear returns. Scaling back pricing while maintaining these costly development pipelines creates a financial squeeze that few automakers can sustain indefinitely. Every delayed update or cut feature becomes noticeable when customers are paying closer attention to value. The workforce feels this shift too. Efficiency drives, restructuring talks, and quiet hiring freezes are beginning to surface, even as public messaging remains optimistic. Internally, the message is clear: the era of easy profits is over. Every department must justify its existence in a market that no longer rewards excess. What makes this moment especially dangerous is how quickly sentiment can flip. Right now, Mercedes is being praised for realism and boldness, but if sales slow again or residuals fall further, that narrative can turn into panic overnight. The same move that looks decisive today could be labeled desperation tomorrow, and all of this is unfolding while competitors are watching closely, learning, waiting, and preparing their own responses. Because if Mercedes proves this model can work, the floodgates open. If it fails, the fallout won't stop at one brand. The next phase of this story is where the stakes rise even higher, as early results collide with financial reality and the industry begins to reveal who truly understands the new market and who is about to be left behind. As the months unfold, the data coming in will become impossible to spin. Sales volumes, average transaction prices, lease residuals, and dealer profitability will all expose whether this shock strategy is sustainable or simply buying time. Mercedes executives know this, which is why internal reporting has become more intense, more granular, and far less forgiving than before. Every region, every model, every trim is now under a microscope. One of the most telling signals is how Mercedes is prioritizing certain nameplates while quietly deprioritizing others. Core models that anchor volume are receiving marketing support, production stability, and flexible pricing, while niche or image-focused vehicles are fading into the background. This is a sharp departure from the brand's past obsession with expanding its portfolio at all costs. Focus has replaced ambition, and that alone reveals how serious this moment truly is. Financial markets are watching closely as well. Investors are less interested in futuristic promises and more focused on cash flow and inventory discipline. Any sign that margins are eroding faster than volumes are growing will trigger pressure from shareholders who have little patience for long-term narratives in a volatile economy. Mercedes is now balancing public confidence with private caution, a delicate act that leaves little room for error. Consumer behavior is also shifting in response. Buyers who once saw Mercedes as untouchable are now treating it like a negotiable commodity. Negotiation dynamics are changing, and that psychological shift is almost impossible to reverse. Once luxury feels negotiable, the power dynamic permanently tilts toward the buyer, reshaping how transactions unfold across the entire premium market. At the same time, regulatory pressures continue to mount. Emission standards, safety requirements, and regional compliance costs are not slowing down just because the market is tightening. Mercedes must absorb these costs while keeping prices competitive, creating a squeeze that forces hard trade-offs between compliance, innovation, and profitability. What makes this phase particularly volatile is that it coincides with generational change in leadership and buyers alike. Younger consumers value technology and flexibility over tradition, while older buyers expect consistency and status. Trying to serve both groups simultaneously under pricing pressure is one of the hardest challenges any luxury brand can face. The silence around future product announcements is also noticeable. Mercedes is no longer overpromising years in advance. Instead, it's moving cautiously, reacting to conditions rather than shaping them. That restraint suggests a company recalibrating its confidence, aware that the market no longer rewards bold projections without immediate results. And as this recalibration deepens, the next developments will not be announced with fanfare. They will emerge quietly through subtle pricing changes, delayed launches, and strategic pullbacks that only become obvious in hindsight. Because this bombshell was just the opening move, and the decisions that follow will determine whether Mercedes rewrites the rules of luxury survival or exposes vulnerabilities that competitors are already preparing to exploit. Behind the scenes, the internal debate has become more intense than anything Mercedes has faced in years. One side argues that this shift is the only realistic response to a market that no longer supports old luxury economics. The other warns that every concession chips away at a century-old reputation built on scarcity, engineering pride, and unquestioned prestige. This isn't just a pricing discussion, it's an identity crisis unfolding in real time. Dealer networks are now redefining how they sell the brand. Sales conversations that once centered on heritage and craftsmanship are pivoting toward cost comparisons, incentives, and financing structures. That change alters the entire customer experience. And once that experience changes, expectations change with it. Mercedes is effectively retraining both its sellers and its buyers, a process that carries long-term consequences no spreadsheet can fully capture. There's also a growing contrast between public optimism skepticism and private caution. Official statements emphasize resilience, adaptability, and strategic strength, but internal planning reflects a far more defensive posture, with contingency scenarios built around further demand drops, extended inventory cycles, and prolonged margin compression. When a company of this scale prepares for worst-case outcomes, it signals how fragile conditions really are. The technology roadmap is another area under strain. Advanced driver assistance, digital ecosystems, and autonomous ambitions all require sustained investment, yet every dollar committed to future tech is a dollar not available to stabilize today's balance sheet. Mercedes is now forced to decide which innovations truly justify their cost in a market that is no longer rewarding experimentation. Global competition is intensifying at exactly the wrong time. Chinese automakers are accelerating into premium segments with aggressive pricing and feature-heavy offerings. These competitors don't carry the same legacy costs, allowing them to undercut established brands without hesitation. Mercedes now finds itself defending territory it once considered secure, and that defensive posture changes everything. Even brand loyalty is being tested. Longtime Mercedes owners are questioning whether the premium they paid in the past still makes sense. When loyalty turns into skepticism, it's a warning sign that runs deeper than sales numbers. Trust, once shaken, is difficult to rebuild, especially in a market flooded with alternatives. What's most unsettling is that this move may force Mercedes to continue down this path even if it wants to reverse course. Momentum builds quickly, and the market adapts faster than brands expect. Pulling back too soon risks inventory pileups, while pushing forward risks permanent brand erosion. There is no easy exit from this strategy, and as these pressures converge, the next phase will not be defined by announcements or headlines, but by consequences that unfold slowly, quietly, and relentlessly. Because the real impact of this bombshell isn't what Mercedes said, it's what the entire industry is now being forced to do in response. And that chain reaction is only just beginning to show its true scale. As the industry absorbs these changes, a subtle but powerful shift is taking place in how luxury is measured. It is no longer about how exclusive a badge appears, but about how rational the purchase feels in an uncertain economy. Mercedes has effectively acknowledged this shift, even if it hasn't said so outright. By moving first, it has forced the conversation out into the open, where no premium brand can ignore it anymore. Marketing strategies are already evolving. Flashy, aspirational campaigns are giving way to messages focused on practicality, efficiency, and long-term ownership value. This is a radical change for a brand that once sold emotion before logic. The fact that Mercedes is willing to lead with numbers instead of narratives speaks volumes about how deeply consumer priorities have changed. Product planning meetings now revolve around risk mitigation rather than expansion. Every new model proposal is being scrutinized for break-even timelines and demand certainty. Features once added to impress are now questioned for cost justification. This disciplined approach may stabilize the company, but it also signals an end to the era of unchecked innovation in the luxury space. Financing arms are playing a bigger role than ever. Competitive lease terms and creative financing structures are becoming essential tools to keep vehicles moving. This shifts risk from the showroom to the balance sheet, increasing exposure if market conditions worsen. Mercedes is effectively betting that it can manage this financial complexity better than its rivals. The psychological impact on consumers continues to deepen. Buyers are learning that waiting pays off. Each round of incentives reinforces the belief that prices will fall further. This expectation can stall demand, creating the very slowdown the strategy was meant to prevent. Managing that perception is now one of Mercedes' most difficult challenges. Regulators and policymakers are also watching closely. A major luxury brand signaling distress, even indirectly, raises questions about broader economic health. Automotive manufacturing touches employment, exports, and technological leadership. Mercedes' moves are being interpreted not just as corporate strategy, but as an indicator of where the global economy may be heading. Inside the company, the sense of urgency is unmistakable. Decisions that once took months are being made in weeks. Hierarchies are flattening, approvals are accelerating, and tolerance for underperformance is shrinking. This intensity can drive focus, but it can also lead to mistakes if pressure overwhelms judgment. And as this environment hardens, the industry is approaching a point where adaptation is no longer optional. Mercedes has fired the opening shot, and the market is reorganizing around it. The next developments will reveal whether this bold gamble becomes the blueprint for survival or a cautionary tale that reshapes luxury automotive strategy for years to come, as the consequences continue to unfold in ways no one can fully control yet. What's becoming clear is that Mercedes has stepped into a phase where momentum itself becomes a risk. Once the market senses vulnerability, it begins to test boundaries, pushing harder for concessions and questioning every price point. The brand that once dictated terms is now responding to them, and that reversal changes how power is distributed across the entire buying process. Internal benchmarks are being rewritten. Success is no longer defined by record margins or aspirational growth targets, but by inventory turnover, cash preservation, and operational resilience. This signals a defensive posture that contrasts sharply with the confident expansion narratives of previous years. Mercedes is no longer chasing dominance, it is securing footing. The ripple effect on product quality is a concern that executives cannot openly acknowledge. Cost controls, supplier renegotiations, and simplified configurations all carry the risk of eroding the tactile excellence customers expect. Even small changes become noticeable in a brand where perception is everything. Maintaining standards under pressure is one of the hardest challenges Mercedes now faces. Competitors are dissecting every move. Some see opportunity in Mercedes' retreat from ultra-premium positioning, while others see a warning sign and are preparing similar pivots of their own. The industry is effectively running a live experiment, watching whether volume-driven luxury can succeed without collapsing brand equity. The global economic backdrop offers little relief. High borrowing costs, geopolitical uncertainty, and uneven consumer confidence continue to suppress demand. Mercedes is executing this strategy in one of the most unforgiving environments imaginable. There is no tailwind, only resistance, which makes the outcome even more uncertain. Employee morale is another silent variable. Transformation under stress creates anxiety across organizations. While leadership emphasizes adaptability, the workforce feels the weight of constant change. Retaining top engineering and design talent during a period of belt tightening is critical, yet increasingly difficult. Even the definition of premium is under negotiation. Technology parity across brands has narrowed the gap that once justified higher prices. When mass market vehicles offer advanced features once reserved for luxury, the value proposition must evolve. Mercedes is being forced to answer a question it long avoided: what truly makes it different today? And as these questions stack up, the company moves deeper into uncharted territory. Each quarter will either reinforce confidence or amplify doubt. The margin for error is shrinking, the scrutiny is intensifying, and the consequences of this bombshell decision are still unfolding, layer by layer, as the industry braces for what comes next.